What's up, Investor Channel? Going to do something a little bit different today where we take a look at a 10Q and a balance sheet and a cash flow statement of a company that is not doing well. So basically a penny stock. So what I want to do is take a look at this company, NXTID, ticker symbol NXTD. Now, the first huge red flag should be that the share price is under $1. For me, I would not ever buy a share of a company that's under $1 and typically under $5 or maybe even $10. But I'm not here to give you investment advice. I'm going to show you why investing in these kind of companies is a terrible idea. So I'm going to jump over to their latest 10Q. This was filed back, I think, just about a month ago. And let's just jump right into the numbers because these are the most important thing. First thing I want you to do, and if you've been following the channel, I want to see what these numbers are. Are these in millions? Are these in thousands? Well, if it doesn't say anything up here, these are just as they read. So this is $1.3 million. This is $150,000. We also want to notice the term or the time frame this is. This is from basically the first of the year to the current time period that this 10Q covers, which is from December to September 2019. Now, I want to do something a little bit different. A lot of times we're starting off with the asset side of the company because with Apple and Nike and some of these companies, it's rather impressive. But what I want to first do, and this is what I often do with these companies that are struggling, that are not doing very well, I like to go to the liability side first. We'll come back to the asset side to kind of show you why this company is in such dire situation. So again, on the right-hand side, we've got the first of the year. Right here, we've got the current numbers as of September 30th. So let's come down to this liability number here. And we're going to take a look first at accounts payable. So think of this as maybe like a credit card that you have due. Notice that it's ballooned from 1.2 million all the way up to 2.1 million. Again, this is money that is owed very soon, within the next, call it 6 to 12 months. Then we have accrued expenses. This could be maybe salaries, or it's very similar to accounts payable. It's about the same, as it was in the first of the year, but again, not 1.5, $1.6 million is a lot of money. So this is money that the company literally has to pay. Short-term debt. Looks like they've extinguished this very short amount of debt, so that's probably a good thing. What more than likely happened is they rolled this over into maybe another portion of debt. Here we go, a term loan facility that is current. Think of this as like your mortgage, and this is what is due very soon, maybe over the next, call it 12 months. And if you don't pay this money, the bank is not going to be happy, and you can imagine what they would do to your house, let alone a business. It's gone from about $1 million in the first of the year all the way up to over $2 million. Now we've got other liabilities. This is a very small number, but again, for a company like this, not insignificant. That takes us to a total current liabilities. This is money that is due very soon, to $5.8 million. Okay, that's not good. And I'll get to why in a second. Now, other liabilities, these are longer term. Think about this as the total amount you owe on maybe a credit card. This is a total amount better example, maybe a total amount you owe on a car lease or a mortgage. It's not money that is due today, but if you don't pay it, bad things will happen. So we have a long-term debt extinguished or probably rolled over into another amount. Here's the term loan facility. So it's gone from 13. Looks like they've paid it down a little bit, but it's still over $10 million. Okay, this is separate from the current liabilities. Current liabilities are about 5.8 million, but then the long-term liability is about 10.1 million on a term loan. Now we have other long-term liabilities here at $1.1 million. And then we have a deferred tax here. We know what happens when you don't pay your taxes, $365,000. That brings us to total liabilities, which is this line here plus this line here. That takes us to $17 million. Now, you might say on the surface, look, it's gone from 21 million down to 17 million. Probably a positive, okay? It's down about, $4 million or so, a little less than that. So might be a positive that, hey, look, we've gone from 21 million down to 17. Now, Why did I do this in reverse? I want to, again, keep this in mind. We owe this company, we owe $2.1 million right now, basically, for accounts payable. We owe $1.5 million in other expenses here, and then we have a basically $2.1 million we owe on a term loan and some other expenses here. That is not good. That's $5 million that we need to pay very, very soon. Now let's come up here to current assets. Here's cash. Notice it's gone from about $425,000 up to $1.3 million. You might say, hey, that's pretty good. But let's get to this next line. It looks like it's gone from restricted cash into basically current cash. So notice that restricted cash went from 1.1 down about $1 million to 150,000, excuse me. And so that gives us kind of total cash here, including restrictions, at about, call it $1.5 million. Okay, again, I want to highlight this again. We have total, call it cash on hand, $1.5 million. Remember, we have accounts payable here at $2 million. We have other expenses here at $1.5 million, and we have a term loan at $2 million for a total current liabilities at $5.8 million, let alone total liabilities of $17 million. So you can see why I did this in reverse. $5.8 million in current, $17 million in total, and we have about $1.5 million in cash. Guys, if this was your bank account or your financial situation, I'd be blowing a red flag and waving a red flag and blowing a red horn, because this is not good. We have accounts receivable. Look how this has gone down. It was 247. It's gone down. Looks like we've collected some of that money, but we don't actually have a lot of money owed to us here. We have inventory here at 1.5. We actually have more inventory than cash on hand. That is not good. Notice how it's also gone up, 800,000 up to 1.5 million. That is not good. You can almost, in every single company, I don't care if it's Gucci or if it's this company, having inventory on hand is you're not going to get the full value for this. So this might say 1.5 million. You know, if you were to have to liquidate this company, you're not going to get anywhere close to that. Finally, we have prepaid expenses. Is that what this is? Yes. It's about the same. Basically, this is expenses that the company has had to prepay. Now, on the surface, maybe your CPA or your financial class will say, hey, look, assets are about the same. Well, guys, remember, here's our total current assets at $3.4 million. Our total current liabilities are $5.8 million. That's not good. So let's hope maybe in some of these other assets, some of this other stuff might pay the bills around here. So we've got equipment, $180,000. That again, you can discount all this in a liquidation or kind of a bankruptcy. We've got furniture and fixtures. I know if you sold the furniture around my house, you're not going to get the full value for it. Neither is this company. And we've got tooling and molds. So a negligible amount. We have less than $1 million of this kind of property and equipment. And again, you can discount this in any kind of bankruptcy or liquidation. Finally, we have accumulated depreciation. Hey, it's nice to have some depreciation that you can write off on maybe your taxes or something. But look, this is not going to pay for your term loan. This is not going to pay for your accounts payable. Cash and cash equivalents will, and we only have about 1.5 of that. Okay, now we've got property and equipment, only about 113,000. We have right of use asset. I don't know what these are, but I'm going to guess you're not going to be able to cash that out and pay a bill with it. Now, here's where it gets really ugly and where you should be waving red flags if you look into a company like this. Goodwill. $15 million. And I put dollars in quotes because, again, you can't go to the bank, go to an ATM and pull out your goodwill. Okay, it doesn't exist. It exists on the balance sheet as for accounting purposes only, essentially. You can't sell this. You can't go to a bank and have them give you money on this. It's not going to happen. Okay. And again, right under this, other intangible assets. Another thing, $6 million. Notice the biggest numbers in this is the hugest red flag you can ever see with these penny stocks that are under $1 and even up under a couple dollars is on the asset side. The biggest number is in goodwill and intangible assets. This is terrible. Over $21 million in intangible assets and goodwill. Of the 25, again, here's total assets right here. We have 25 million in assets, total assets, and over 21 million of that is in something that you can't even touch or feel. I mean, I can't tell you how disgusting of an investment these shares are. Okay, when 21 million of the 25 million is in goodwill and intangible assets. I would run from this company. I wouldn't even think about you. If you even gave me the shares for free, I wouldn't even want them. That's how bad this is. This is absolutely disgustingly terrible. Okay, just an absolute disaster. I can't tell you how bad this actually is. So we'll go through here. I don't think you can bet that this company is diluting shares. We'll get to that maybe in a minute here. Let's take a look at kind of a statement of operations, because maybe this company is going to be able to turn things around. Even though it looks the balance sheet looks as dire as I've seen in a long time, maybe the operations are turning around. Maybe some things are coming to fruition. Here we go. Again, we want to make sure we see what terms these are. These are numbers as written. So this is 13 million, this is 3 million, and so on. Again, we want to also see the time frame we're analyzing this as. This is for 9 months ended back in 2018, and this is for 9 months in 2019. To give this company some credit, I actually like how they're laying this out. It's not super complicated. It's actually very easy to understand here. Some companies in this poor of a financial conditions try to, make the numbers look better than they are. This company isn't. So, kudos for that. So we have some revenue here. This company actually has real revenue, but notice it is flat. Okay, for a company that is piling up debt and has some bills to pay, flat revenue, not always the best thing. Although it's not down, it's basically the same. We have cost of goods sold, relatively the same. That's good. That is actually a good sign. It's showing that their costs are not rising, maybe from tariffs or other issues and things like that. Now, gross profit, again, almost identical to 9 months a year ago. Now, operating expenses. Because, hey, look, if they were churning out, if this was net income, this company's stock price would be far different. But this is not net income. We have to take in other expenses here, and this is operating expenses. We have general and administrative, probably my favorite, and I'm sarcastically saying that's my favorite expense. It's not. Because oftentimes it just goes to salary and other things that might not be needed. We've gone down here. This is good. This is a company that does need to be cost cutting or watching what it's spending. It's gone from 5 million down to 4 million. Selling and marketing. They sure need to be doing a lot more of this. I not as excited that this has gone down, but maybe they're keeping some things under control. It's gone from 3 million down to 2.5 million. And research and development has gone from about 500,000 to 900,000. Again, as a company that needs to be, maybe making more money, I'm not really tripping about R&D. It sure would be nice if this 4 million maybe went down a little bit into here and a little bit into here. Maybe some more positive things would be happening for this company, but that's neither here nor there. Now, notice we've had gross profit of about 10 million. We have total operating expenses of 8 million. Come down to operating income. Hey, $1.8 million. That's $1 million more than last year. Boy, if you, again, in a vacuum, this is why you can't analyze these companies in a vacuum. Take like one set of data and then say, 50 cents a share, this is a value. Because look, they grew operating income over $1 million. It's like, this is like 100%, gain over a year. Okay, that looks great. Okay, but again, this is a company with lots of bills to pay. Now let's take a look at other income, or in this case, expenses. We have, what is this? Interest expense right here. So this is the term loan. Think about this is what you pay the bank for your mortgage or your credit card for your bills. $2.4 million. Again, we made $1.8 million, but we owe the bank $2.4 million. We call this being underwater right here. Loss on extinguishing of debt. So it looks like they paid off some debt, but they had to maybe pay a penalty or something like that. Another $2 million. That's not good. Okay. And we've got some other stuff here that's not super relevant right now. But we've got a total other expenses, $4.7 million. Again, we quote unquote operating income was 1.8. That's good. Went up over last year. But look what we owe. $4.7 million. That is not good. Lost before, here's what we lost, essentially $2.9 million. And then we've got some discontinued operations. I don't want to, for the sake of this video, I'm not going to get into that here, but here's our net loss. Okay, here's our net loss right here. $12 million. That's why you can't take numbers and just, a great investor takes all these numbers into account in totality. You can't just look at I'm sure this company in their press release said, hey, operating income year over year went from 870 to 1.8 million. Guys, that is like a double in just a year. That is awesome. But no, last year you lost 3.9 million and now you lost 12.3 million. That's an absolute disaster, especially considering you have $1.5 million in the bank. Okay, you have $1.5 million and you lost $13 million in 9 months. Guys, this is why the stock's at 50 cents and it's probably a little overvalued at that point. Okay, we got loss per share. Another thing I was going to tell you about, weighted average number of shares outstanding. Notice it's gone from 24 million to 28 million. That's a cool 4 million shares. What's that? That's like a 10%, maybe a little more than that. Actually, that's close to 20% dilution right there because, yeah, that's a lot. Okay, that's not a insignificant amount of dilution there. And notice the net loss per share went from 16 cents to 44 cents. This is negative. That is an absolute disaster. This is, again, another statement of operation. The one I just showed you was for 9 months. This is for 3 months. So it's kind of showing you in a tighter window here. So we've got gross profit here. Again, about the same, not bad. We've got operating expenses actually ticking down. That's exactly what you want to see. Again, operating income like tripled. Okay, that's amazing. That's what they're going to put on the press release. That's what people that are going to pump the stock are going to tell you. Guys, operating income went from 228 to 750,000, 730,000. That's a triple. Okay, hey, that's great. But look what else tripled. The net loss, okay? Or other expense. This is not the net loss. This is operating expenses went from 463,000. That's a negative. That's a loss to $1.1 million loss. Come down here to the net loss. Look what they lost just in 3 months. $7.6 million. Okay. The previous 3 months time frame in 2018, they lost 1.1 million. So it has accelerated drastically. And they're accelerating the dilution. It was 25 million shares back then. Now it's 30 million. That's 5 million more shares on the market. And as a company that has very little money and lots of expenses, that is not good. And here's where they're kind of showing you in these change in equity, they're showing you kind of the issuance of common stock and things like that. Guys, I just wanted to make it a short video. I want to show you a company in distress. And just be careful about reading press releases of these tiny micro cap companies that have, share prices under a couple dollars. Okay. With all the great companies in the world, I don't think you need to be playing around in a roaring bull market. There is no reason to go around and bottom fish at these companies that are worth under $1. It just makes absolutely no sense. And then You can combo that now with the knowledge that you have by looking at the assets. Look, here's current assets, $3.4 million. Where's the current liabilities? $5.8 million. That's red flag number one. I would simply just close the window, close any kind of trade execution that you might have on a stock like this, and move on to the next one. Thanks for tuning in. We'll be back some other time. Hit that like button, hit that subscribe button. Leave me a comment. Appreciate you watching. See you soon.